One of the scenarios we have, so split capital clients, most advisors are telling split capital clients that SMSF property plans are dead. Tonight is about a vehicle the new legislation didn't touch. So one of the important things with super that a lot of people have got wrong is that the misconception is you can no longer buy residential property in super. That's actually not the case. You can absolutely buy any residential property in superannuation you so desire. You just can't use an LRBA arrangement to purchase it. Mm-hmm. That said, there are other strategies we can use. So last week we went over the strategy where someone had a lot of money in super. They can just simply go buy a residential property outright. They can rent it out from their super fund and be quite happy. Now, where that's not the case, and I had clients that are in this situation today, so that's a couple, they've been long-term property investors for a long time. So they had a couple of $1 million worth of equity in property outside super and 500 inside. And we're going to use the strategy that we're talking about tonight, which is the Ungeared Unit Trust, to get property into superannuation. And for buyers agents, it's your clients that you've been working with for 5 or 6 years that have built up some equity, where this is a plausible strategy if it suits what they want to achieve. So where you've got two silos where neither one's enough, there's 200 in super, 300 grand in a family trust. We need an extra 500K, and it's split between two legal structures. The reality is buyers agents and accountants are telling clients the deal is dead because residential LRBAs are gone. They're conflating a borrowing ban with a co-investment ban, which is not the case, as I said. The Ungeared Unit Trust is the vehicle we can use, a vehicle the new legislation explicitly in the budget papers did not restrict, okay? So unit trusts were specifically excluded. So the Ungeared Unit Trust buys the property outright without taking on any debt, and the deal gets done. So if we could just have the next slide, please, Tristan. So LRBAs were killed because the Labor and the Greens deal targeted leverage borrowing inside super. The ban is specific. It applies to limited recourse borrowing arrangements over residential property only. So we have a situation at the moment where a client is buying a commercial property and they are using an LRBA to buy it, and there's no restrictions on that whatsoever. Okay. The catch-22 is clients have genuine buying power, and it's split between super and personal trust structures. Neither side alone has enough to actually get the asset on its own. So we need to combine those two pools of equity in order to get the purchase done. Now, this Ungeared Unit Trust is only allowed in conjunction with the self-managed super fund as long as the asset that gets held in the trust isn't used for security for any borrowing. It's then compliant, and the way it works is we nominate a fixed number of units prior to the purchase that the unit trust will have. So if you're, usually I just use $1. So if someone's buying a property for somewhere close to $1 million, we just have 1 million units. So if the super fund puts in 350 grand into the unit trust, it's purchasing 350,000 units. If the external party is buying 650,000 units, putting in $650,000, it receives 650,000 units and vice versa. Okay, Tristan, can we have the next slide, please? So how it flows is the SMSF is effectively just a unit holder in the trust. That's it. and it's allowed to purchase those units so long as that trust has no gearing at all. The other borrower is a family trust. In this situation, we're trying to buy a $550,000 regional property. The clients here have got 300 grand in a family trust. They make that investment into the Ungeared Unit Trust. It's now got 600 grand that goes out and affects the purchase. It's a 50-50 ownership between the SMSF and the family trusts, and all distributions from the unit trust and associated with the property are distributed in that way. Can we have the next slide, please? So the catch is no debt or a lot less debt. So the SMSF to buy a residential property can no longer borrow. So just can't do it. You can't mortgage the asset on the Ungeared Unit Trust, and you can't give a security over that asset. So the unit trust itself must buy the property with cash. It's got to be zero debt. Otherwise, it fails the SIS test and it becomes a non-complying trust. Asset needs to be sold. It's really the only way of unwinding it, and so causes a few issues. But as long as we keep the zero debt in that unit trust, it's okay. If we could just have the next slide. So what keeps your ATO happy is it's passive only, so we definitely don't do businesses. It's property only. We still can't purchase a residential property from a related party, and this is a really important part of it, is that the unit trust can't be used to circumvent the other rules of the SIS Act. It can only complement them. So you can't go and buy the family home with this unit trust using super fund money. That definitely will contravene the Act. It's got to be from an unrelated party. You can't sell it to a related party. It's still residential property, and all the old restrictions on purchasing of residential property using superannuation funds still apply. Okay. It also can't be leased to related parties. So the unit trust, it's important to understand this. It's not a way of circumventing the rules of the SIS Act. It's just a means by which to pool multiple assets in order to effect a residential property purchase. The rent has to flow directly to the Ungeared Unit Trust. Can't go out to the individuals. This is also not an opportunity for creative accounting. Having a number of these that we're the accountants for, I can tell you the auditors in every situation every year are on the lookout for that. So that's an important fact. It's got to be done in accordance with the unit holdings. We have the next slide, please. Okay, so calculating the split, this is a great example. SMSF puts 300 grand into an Ungeared Unit Trust. Family Trust puts 300 grand in. It's 50-50. So logically, everything is split 50-50. So the rent that comes in, it pays the costs of the unit trust, and hence that gets split 50-50. If it's sold, the capital gain gets split 50-50. Unfortunately, in this situation where a family trust is the other unit holder, obviously after the 1st of July 27, there'll be potentially a 30% tax on that. Those units can also be held as individuals, so that's an important distinction as well. But the operation of the unit trust has got to be, as we call it, in accordance with the unit holding. So if there's 1 million units and there's $1 million worth of income, every unit gets $1. That's effectively the way to look at it. Can we have the next slide, please? Righto. So testing it. The just short client, they got 300 grand in super. They can't buy a residential property with that. Same in their family trust, similar problem. We can use the Ungeared Unit Trust to pool those assets and affect the purchase. The Ungeared Unit Trust buys it outright. The rent flows in accordance with the unit holdings. In the SMSF, 15% accumulation, 0% in tax, or zero tax in pension phase on the rental income. Trust is obviously at your marginal tax rates. Another way this can be done is with multiple members. So we can have the SMSF as one unit holder. We can have multiple other entities holding those units and affect it that way. Can we have the next slide, please, Tristan? Righto. So first and foremost, like everything, we've got to do a feasibility before we undertake these things. We've got to look at what the resources are and what the strategy is, and look at whether or not the Ungeared Unit Trust is a viable solution for the client. So first of all, my client has 180 in super, 400 in their personal name, not a trust. Is there a compliant way to pool? Yeah. So obviously there is. The clients can just buy the units in the Ungeared Unit Trust as individuals. Two of my clients are business partners. Each has their own SMSF. Can both of those co-invest? Yes, they can. So in this scenario, you could have hypothetically two SMSFs, each with two members, two partners in each SMSF. So you could effectively have the two SMSFs as unit holders and each of the four members of the two funds as unit holders. So you would have 6 unit holders in this scenario. Where you do need to be careful there is not breaching the managed investment scheme rules as far as unit holders go. So if you end up with a unit trust that has more than 24 unit holders, you end up, i.e. 25 or more, it is potentially liable to be seen by ASIC and APRA as being a managed investment scheme, and you don't want that. So just keep it to less than 10. The property we're targeting was previously owned by the client's spouse. Does that create a related party issue? Absolutely. That just can't happen. What happens if one party wants to sell their units in 5 years? Does the whole structure unwind? No. This is a really powerful forward planning situation for Ungeared Unit Trusts. We're starting to use them a lot more with estate planning, where a couple has children. They've bought a property in an Ungeared Unit Trust 10 or 15 years ago. Their children are now adults, have their own SMSFs, and want to start investing in property. The retired parents, they want cash, so they can sell their units in the unit trust to the SMSFs of their children to hold them in accumulation phase, and the retired parents end up with the cash to fund their retirement. It's a really effective way of creating a long-term family asset. It's a great outcome. Yeah, and it also means, kids can start to build up property assets in their super much earlier because they can buy units off mum and dad that might be worth $1,000 each. So if they've got 10 grand, they can buy 10 grand's worth of units. It's a really powerful estate planning tool. The other advantage of that is that if that happens over the course of their lives, you don't end up with a big lumpy asset to transfer when the parents pass away. So that's another effective way of managing the asset. Yeah. So I hope that was insightful. I didn't go too quickly. As I said today, we actually were undertaking planning for a couple. They have substantial assets outside of super, and they want to invest their super in residential property. They want to invest it in an established area, and they want to have some tax advantages along the way. So the strategy we're undertaking for them, they've seen their buyer's agent. They're going to buy a infill block and put a duplex on it. The project's 1.4 and they have 500 grand in super. What we will do is an equity release against 2 of their investment properties to free up the other 900,000. They will then, each of them, invest 450,000 into an Ungeared Unit Trust, and their self-managed super fund will invest 500,000 in an Ungeared Unit Trust. That ungeared unit trust will be the client for the builder and the owner of the land, and they will end up with an identical pair of duplexes that will be strata titled in their ungeared unit trust. Now, the really exciting part, well, the bit that I find exciting, is maximum super contributions this year for a couple, 32,500 each, 65,000 in total. So we've got about 50 grand from that. That unit trust can buy 50 grand of those units each year. That 50,000 ends up back in the client's hands after the super contributions have been made. It's not taxable income because it's a capital disposal to their super fund, and they end up with money to pay the capital down on the loans that they've taken out, with money that's taxed at no more than 15%, as opposed to, in their situation, taxed at 38.5%. And so they get to, for each $100 they can do that with, they can pay $85 off the loan, as opposed to in their own names, they would only be able to pay off $65 from the loan. So it's a lot more effective. You pay the loan off a lot quicker. Plus, they have the access to the income that's generated into their SMSF to do the same thing with, and the income from the rental property in their hands. So it's a really powerful strategy in that scenario. The other strategy where it works well, where you are doing equity release loans, is someone can undertake a property purchase this way and borrow substantially less. So if they're wanting to buy a $2 million property, can't do it in their own name, but they've got $1 million in super, that cuts down the debt they need by half. So it's a really effective way of getting the same asset with a lot less borrowing. And across all of their multiple entities now, they have a much higher after interest income to pay down the debt. So you pay the debt off a lot faster. The asset is slowly purchased from the individuals by the self-managed super fund. Once that unit trust, all of its units are held by the SMSF, that property could potentially be sold. Once the members turn 60 and have transition to retirement pensions on them, that property can then be sold and pay no capital gains tax at all. Zero capital gain. So they've owned an asset that they've been able to negative gear in their own name, reduce their debt with their super, claim the interest and depreciation deductions for probably 10 or 15 years, and then sell it and pay no CGT at all. That's a pretty powerful strategy to put in front of your clients, that you, particularly those ones that buyers agents have been working with for a number of years. So Brendan, I know you've got plenty of clients. You've been, had a long relationship with them. They've done multiple purchases.
Yes.
They've got equity available. That is a lay down misère for high income earners, property investors that want to manage their capital gains tax and still want to access the negative gearing aspect of purchasing a property. Buy an established area, build a duplex. I know it's expensive. Pool resources to make it happen, and then hold it until you're 60 and you can dispose of it CGT free. The tax rate is zero. I find people enjoy that. As an accountant, I get really excited about that part. I'm really excited. So anyway, that's what we've got for this evening, guys. So is there any questions? That being the case, I do have an interesting tidbit from one of my podcasts I listen to. So an economist through the week has crunched the numbers on the difference under the new rules of buying a house and land package or establishing investment property that can't be negatively geared in an established area. And they found, on average across Australia, so this is all averages, the whole lot, over a 20-year period, an investor is $468,000 better off buying a property ineligible for negative gearing but in an established area rather than a brand new house and land package. Now, I raised that at the end of this discussion where I've been talking about buying a block of land in an established area and building a duplex is that under that scenario, it's even better because you get all the advantages of owning property in an established area because they tend to increase in value better. But in addition, you've done some development and created value right at the start.
Mm-hmm.
If we're doing that in ungeared unit trust with an SMSF, we also add to that in that we can negative gear and pay no capital gains tax under the new provisions. So it's a very powerful planning strategy.
Mm-hmm.
So I hope that was an interesting enough tidbit for you this week, Brandon.
That's amazing. I'm loving that. Last couple of points there, Matt, were just stellar.
Thanks. So, look, I think the big thing that all of us need to look at since the budget is that people want to have their super invested in property because of the variability of returns from traditional super. So if your super is going to be invested in stock markets around the world, it's going to be in government bonds, it's managed by people you don't know, and now with 12% super, our super is worth a hell of a lot more than it ever has been. That being the case, the people that we talk to about these strategies, these property investment strategies using superannuation, it is about the security blanket that they feel by investing that capital in property. And I think the important part for us as strategists is to be able to impart upon them the strategies where they can continue to get substantial tax advantages while they go about their working lives, and a tax management strategy for asset disposal at the end so that they don't have to incur capital gains tax, reducing their retirement income streams. And the two ways of doing that is the unit trust owning the whole property and selling the asset to the unit trust after age 60 when a transition to retirement pension has been commenced for all members, or the super fund can just simply sell the units to someone else, another super fund, and let them enjoy the advantages of it. They can sell it to someone who's not a super fund, sell it to other individuals, but units at a time. And hence the family capital gets transferred via the units in the unit trust. That's a really powerful strategy.